Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Uber Technologies Inc. Annual Report. Uber Technologies Inc. offers a wide range of services through its three main segments: mobility, delivery, and freight. The mobility segment provides various transportation options such as ride-sharing, car-sharing, micromobility, rentals, public transit, taxis, and other modalities. This segment also offers financial partnerships products and advertising services to riders. In addition to mobility services, Uber's delivery segment allows consumers to search for and order food or items from restaurants and retailers, with options for pickup or delivery. The company also provides a white-label delivery-as-a-service platform called Uber Direct for retailers and restaurants. The freight segment manages transportation and logistics networks by connecting shippers and carriers in a digital marketplace. This includes upfront pricing, shipment booking, and an on-demand platform to automate logistics transactions for businesses of all sizes. Uber Technologies Inc. (UBER) stock price has experienced a significant decline in the past year, dropping by over -14.11%. Several key news events have contributed to this drop. One major factor was Uber's fourth quarter 2025 earnings report, which missed expectations and provided a conservative outlook for the first quarter of 2026. This led to a sell-off, with Uber's stock down 14.36% year-to-date as of February 14, 2026. Another significant concern is the growing threat from autonomous vehicle services offered by companies like Tesla and Alphabet's Waymo. Ongoing worries about this competition have put pressure on Uber's stock, leading to a 22.1% drop from its record close in October 2025. This consistent threat has been a major factor in the stock's underperformance. Additionally, a recent legal verdict in an Arizona driver assault case has also contributed to the negative sentiment surrounding Uber. A federal jury ordered Uber to pay $8.5 million, which rattled investors and added to the company's woes during this period of significant stock declines. These factors have all combined to cause Uber Technologies, Inc. stock price to drop in the past year. Uber Technologies, Inc. market capitalization of $146 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Uber Technologies, Inc. holds a significant advantage in their industry. Uber Technologies, Inc. trades at a lower price-to-earnings ratio of 15 times and a higher price-to-book ratio of 5.35 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On one hand, geographic expansion has been a significant driver of revenue growth, with notable increases in the US and CAN and EMEA regions. Additionally, increased market share in APAC and Latin America has contributed to revenue growth. Strong performance in key markets, such as the mobility segment, has also driven revenue growth. For instance, the mobility segment experienced a 94% increase in revenue from 2023 to 2025. On the other hand, disputes with HMRC over VAT remittance have led to a decline in revenue, resulting in $1.8 billion in assessments. Changes in UK legislation affecting VAT remittance and delivery segment revenue decline have also contributed to revenue decline. The consistent year-over-year growth rate of 18% from 2023 to 2025 is a notable trend, indicating steady revenue expansion. However, the decline in freight segment, adjusted EBITDA by 55%, highlights areas that require attention. Investment gains and losses have also had an impact on revenue, with a net unrealized gain of $985 million in 2024 and a loss of $802 million in 2025 for Aurora Investment. The sale of remaining interest in MLU BV resulted in an immaterial loss, while the Careem Technologies investment recognized a gain of $204 million in 2023. Overall, geographic expansion, increased market share, strong performance in key markets, and consistent revenue growth rate have been the primary drivers of revenue growth. On the other hand, disputes with HMRC over VAT remittance, changes in UK legislation affecting VAT remittance, and delivery segment revenue decline have led to revenue decline. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the extracted summaries, operating cash flow was positive in both 2023 and 2024, with significant increases from $3,585 million to $7,137 million respectively. This upward trajectory continued into 2025, where it reached $10,099 million. Furthermore, page 108 confirms that the company generated positive operating cash flow in all 3 years, with a slight decrease in 2025, but still remaining above $300 million. These figures demonstrate a strong financial position for the company, indicating its ability to generate sufficient cash from operations to support its growth and activities. The company's debt level and interest expenses have undergone significant changes over the years. Initially, there was a notable increase in long-term debt, rising by 25% from $8,347 million to $10,521 million between certain periods. However, this trend reversed in 2029 and 2030 when the debt level decreased compared to 2028. In terms of interest expenses, there has been a consistent decrease over the years. Between 2023 and 2024, interest expense dropped by $633 million. This downward trend continued with a further decrease of $154 million between 2024 and 2025, followed by another decline of $89 million in 2025 compared to 2024. These changes indicate that the company has been able to manage its debt levels and reduce its interest expenses over time. The performance of various regions and segments in the company's operations is a crucial aspect to consider. On the positive side, the Learning and Growth segment has shown significant success with its partnership with Arizona State University, enrolling 8850 drivers and their family members. This initiative not only contributes to the growth of the company, but also provides valuable learning opportunities for its stakeholders. In terms of geographical performance, the United States region has demonstrated financial stability, boasting a sufficient existing cash balance to fund working capital needs. Furthermore, the company's foreign subsidiaries have performed well, holding $3.7 billion in cash and cash equivalents as of December 31, 2025. However, there are regions that have underperformed. The French, Spanish, Dutch, Mexican, and New Zealand markets have shown potential issues, indicating areas where improvement is needed to enhance overall performance. These regions require attention and strategic planning to rectify the challenges they face and ensure a more balanced growth trajectory for the company. The management of the company is optimistic about its outlook, citing significant growth in revenue and segment adjusted EBITDA from 2024 to 2025. This growth is expected to continue with the implementation of various growth initiatives, including investments in corporate G&A and platform R&D expenses. However, management also acknowledges certain challenges and uncertainties that may impact the company's performance. These include regulatory matters, such as the classification of drivers as independent contractors, which could have a material adverse effect on the business if not resolved favorably. Additionally, there are concerns about financial performance, including losses on subsidiary stock and capital loss on debt instruments. To mitigate these risks, management is evaluating the impact of the One Big Beautiful Bill Act, OBBBA, on the company's tax strategy and has released $5 billion of its Netherlands deferred tax assets due to strong positive evidence for their realization. The company also has a share repurchase program with $27 billion in authorization to repurchase shares, which will be used at management's discretion. Overall, while there are challenges and uncertainties, the management is focused on growing the company's revenue and segment-adjusted EBITDA while managing its tax strategy and investments. Uber's acquisitions and divestitures. A strategic overview. Uber has been actively engaging in strategic acquisitions and divestitures to expand its services, improve operational efficiency, and adapt to changing market conditions. On the acquisition front, the company has made significant investments in various sectors. One notable acquisition is Careem, which Uber acquired in 2018 for an undisclosed amount. In addition, Uber invested $300 million in Delivery Hero in May 2024 to purchase approximately 8.4 million newly issued ordinary shares. The company also acquired a majority stake in Careem Technologies in April 2023 for $400 million. Furthermore, Uber contributed the net assets of its Russia/CIS operations into a joint venture with MLU BV in 2018. In 2021, the company made an equity investment and entered into a commercial partnership agreement with Move Cars Mobility, SL, formerly known as Garment Investments SL. On the divestiture side, Uber has been streamlining its operations by selling off non-core assets. The company sold its remaining interest in MLU BV to Yandex for $703 million in April 2023. In May 2020, Uber divested certain assets of its dockless e-bikes and e-scooters business to Lime. Additionally, the company ceased offering mobility products in Colombia in January 2020, but relaunched them after making changes in February 2020. Uber has also been divesting lines of business in their entirety by partnering with and investing in other companies in those sectors. This includes the sale of Freight Series, a preferred stock, to a 2020 Freight Series A investor in October 2020. Overall, Uber's strategic acquisitions and divestitures reflect its commitment to adapting to changing market conditions and expanding its services to meet evolving customer needs. The company has demonstrated a commitment to returning value to its shareholders through two key initiatives. Firstly, it has paid dividends on its preferred stock, providing a regular income stream to these investors. However, it is worth noting that the common stockholders have not received dividend payments. In addition to paying dividends, the company has also engaged in share buybacks, which have had a significant impact on its capital structure. Over time, the company has repurchased and retired 97.8 million shares, representing a substantial portion of its outstanding stock. Furthermore, the dollar value of these purchases totals $7.7 billion, indicating a substantial investment in reducing the number of shares outstanding. There are valid concerns about inventory buildup and supply chain disruption. The primary concern is the potential for driver supply constraints, which could lead to a shortage of carriers willing to offer services through the platform. This issue is further exacerbated by fluctuations in currency exchange rates, import and export restrictions, and changes in trade regulations. Additionally, there are risks associated with disruptions in Internet infrastructure or GPS signals, as well as foreign governments shutting down directed services or local governments halting operations at the routing level. These factors could lead to a decrease in the supply of drivers, consumers, merchants, shippers, or carriers on the platform, ultimately causing inventory buildup and supply chain disruption. The overall uncertainty and instability abroad, including war, terrorist attacks, and security concerns, also pose significant risks to the smooth operation of the supply chain. These factors could lead to a breakdown in logistics operations, resulting in delayed shipments and increased costs for businesses. That concludes the financial summary for Uber Technologies Inc. Feel free to comment below, and I will be happy to answer them when possible.